We'll start with 6-1, Miss Duan. So class, our topic for today, class, would be notes receivable. Our concern would be on how to account for your notes receivable. Plus, your notes receivable is basically just a different form of your accounts receivable. If you can remember, if you are still able to uh, recall, even from your basic accounting, your accounts receivable is an asset which represents your right to collect money from your customers or from other outside entities. When we say that your notes receivable class is just another form of your accounts receivable, we mean that your notes receivable is also an asset. It also represents a right to collect a sum of money class. And it is just different from your accounts receivable in the sense that your notes receivable class is evidenced by a commercial document. Unlike your accounts receivable class, normally it is established through the continuing relationship between the entity and its customers. But in your notes receivable, your right to receive money, your right to collect money is actually represented or evidenced by a document. So the right to claim money class, your claim against your customers is stronger under a notes receivable compared to an accounts receivable. A notes receivable is a form of receivable that is evidenced by a commercial document, which normally would be negotiable in nature class and which usually comes in the form of a promissory note. So normally we will be recognizing notes receivable class if our customers, if the parties, if third parties transacting with us will provide us with a promissory note. So as to the nature class, as to what it represents, basically your notes receivable will be the same as your accounts receivable. It's just that our notes receivable is evidenced or backed by a commercial document, specifically a negotiable promissory note. And normally, your notes receivable class will involve a term longer than what you usually give to your customers who you only give a short amount of time to pay you. When we are dealing with promissory notes class, it's highly usual that the terms involved would be longer than what you customarily give out to your customers. So your notes receivable class could actually go beyond 1 year, could actually go beyond your normal operating cycle. Whereas your accounts receivable class normally would have to be paid within a shorter period of time. Even 1 year would be considered long already for the collection of your accounts receivable. Okay, although we cannot actually fix class the length of time as to when we would be able to collect our accounts receivable, because the determination of your normal operating cycle class includes the normal or the average length of time it takes for you to collect your receivables. So it would be wrong for me to say that your accounts receivable can only be collected within 1 year, because it's possible that your normal operating cycle goes beyond 1 year. Okay. But regardless of how long you will actually be able to receive your receivable class, what's wrong? Are you able to hear me clearly, class?
Yes, sir.
Yes, sir.
So regardless of how long we will be able to actually collect our accounts receivable, the thinking there is that the collection would happen within your normal operating cycle. Okay, so if your normal operating cycle will go beyond 1 year, that's fine. Okay, but as long as it is within the normal bounds of your operations class. Whereas your notes receivable can actually go beyond 1 year, 2 years, 3 years, depending on how much time you will be giving to your customers class. Okay, and that is why normally your accounts receivable class will not involve any interest. That is why your accounts receivable will not involve any interest. Whereas your notes receivable class will include interest, whether impliedly or explicitly. We will discuss what I mean by implicit or explicit interest later on. Okay, but considering the arrangement in a notes receivable class, notes receivable will normally involve interest, whereas your accounts receivable will not involve interest. Okay. But again, class, I do not want you to be misled that the primary difference between your accounts receivable and your notes receivable is the length of time. It's actually not. Okay, it's actually in the form of the receivable as to how it is being constituted. Your notes receivable is constituted by the issuance of a commercial document in our favor. Okay. Whereas the accounts receivable class simply arises from the normal conduct of our operations. Okay, but my point really is when we're dealing with notes receivable, it's possible that the collection period goes beyond your normal operating cycle because we are now no longer collecting merely from our sales class. We are already collecting from the commercial document that was given to us. The basis of our collection is not just simply from the sales transactions or for whatever transaction we have with our customers, but the collection now is based on a commercial document that was issued on our favor. And the point why I keep on bringing up the length of time class, the collection period involved in a notes receivable and accounts receivable class, it's because it has an effect on the presentation class. For your accounts receivable, since we expect your accounts receivable to be either collected within 1 year or within our normal operating cycle, the presentation for your accounts receivable class is as a current asset. So that's very important. The presentation of our accounts receivable, when your accounts receivable are going to be reported in our statement of financial position, in our balance sheet, it is going to be presented as a current asset. Why? Because we expect we expect this receivable to be collected within 1 year or within our normal operating cycle. However, for our notes receivable class, since it can happen that the collection period will go beyond 1 year, the presentation for your notes receivable class can come in two forms. Okay, it can either be a current asset or it can be a non-current asset, depending on whether or not it will be able to meet the criteria for the current asset presentation class. Okay, and actually, a single note class, a single promissory note, a single commercial document may result in two types of presentation, meaning we're talking about one kind of receivable class, but when it is presented in the financial statements, it will be presented, uh, uh, portions of it would be presented separately, meaning there will be a portion that will be presented as a current asset, while there will also be another portion that will be presented as a non-current asset. For example, you have a notes receivable class with a value of 5 million and it is to be paid in installment. Okay? The scenario wherein portions may be presented as current and non-current class will happen if the notes receivable class can be collected or will be collected in installments. Okay? If it is to be collected lump sum class, let's say 5 years from now, the whole amount, the entire 5 million will be paid 5 years from now, then the entire 5 million will be reported as a non-current asset. But if the 5 million is to be paid in 5 installments of 1 million each, then there may be a portion class that will be reported as a current asset, while others will be reported as non-current asset. Okay. So normally, sorry, of course, the portion class that will be reported as a current asset will be the portion that we expect to collect within the next 12 months or the normal operating cycle. Okay, so if we're talking about 5 installments of 1 million each class, out of the 5 installments, only the only the first installment will be presented as a current asset because in the next 12 months, we are only expecting to collect the first installment. So the 5 million notes receivable class would actually be split into two presentations. There will be 1 million that will be presented as a current asset, while the remaining 4 million will be presented as a non-current asset. Why is it only 1 million? Because in the next 12 months, we only expect to collect 1 million. Why do we report the rest or the remaining 4 million as a non-current asset? Because the 4 million will be collected beyond 12 months from the reporting date. So that is what will normally happen if we're dealing with notes receivable class that is to be paid in installments. The closest installment will be reported as a current asset, while the remaining installments class will be reported as a non-current asset. And that is where most of the questions will arise, class. You'll be asked how much will be presented as a current asset, how much will be presented as a non-current asset. Okay. As I will share to you later, class, the focus on the discussion on accounts receivable is different from the focus on the discussion on notes receivable. Our focus here is on the presentation, is on the determination of the portions that will be reported as a current asset and the portions that will be reported as a non-current asset. Another focus for notes receivable class is the treatment of the two different kinds of promissory notes class. Your promissory note, which evidences our notes receivable, may either be interest bearing or non-interest bearing. Okay, what do we mean by interest bearing and non-interest bearing? Let's just start with the recitations now. We'll start with number 23. Who's number 23?
Me, sir.
Okay. From what you have read, what's the difference between an interest bearing note and a non-interest bearing note?
An interest-bearing note, sir, has an interest like compounded, sir, annually, while the non-interest-bearing is recorded in the book, sir, without the interest, sir, but sir, the interest, sir, is on inside the note itself, sir.
Okay. I see your point. When we say interest-bearing note class, the promissory note, the commercial document itself expressly states or explicitly states that there will be an interest that will be imposed. Meaning, if you read the commercial document class, there will be a provision there that would declare that interest will be paid at this rate. Okay. Whereas in a non-interest bearing note class, the document is silent. The document does not mention of any imposition of interest. Okay. So when we deal with interest-bearing notes class, the computation of your interest would be very simple because the interest rate is already clearly indicated in the document. But when we are dealing with a non-interest-bearing note class, we would still insist, accounting will still insist, even though the document does not mention of any imposition of interest, accounting insists that there is an implied interest in the transaction. Okay, so I think that's what you meant when there is already interest within the within the amounts. Okay, when we are dealing with non-interest bearing notes class, on the eyes of accounting class, we do not believe that money is going to be owed without interest. We do not believe that the use of money will be for free. So even if no interest is agreed upon, accounting assumes that there is an implied imposition of interest. That is what I was referring to when I mentioned earlier explicitly stated or implicitly stated interest. For interest-bearing notes class, it is clearly stated, it is explicitly stated that there will be an interest that will have to be paid. Okay. Whereas in a non-interest-bearing note, even though there was no agreement class, even there was no specific provision stating the imposition of interest, accounting will insist that you will not extend credit, you will not let your customers owe you without earning interest. Okay, but how do we reconcile that one? It We reconcile that by assuming that everything that we will collect from the customer will already include the interest. Okay, so the amount stated in the note class includes already the interest. And it is now our task to split the value in the note between the principal and the interest. Of course, the value of the document class will state for how much would be the receivable. Okay, in an interest-bearing note, the face value of the note will be considered as our principal. Okay, but in a non-interest-bearing note class, the face value of the note will be presumed to be composed of the principal and the interest. Then you will ask, where then is the interest in an interest-bearing note? The interest is some other amount entirely. It's not included in the value that is stated in the promissory note. The interest would be an addition to the face value of the promissory note. We will be earning interest, and the interest will be an additional amount that we'll be able to collect. We'll be able to collect the amount stated in the promissory note plus interest. Whereas in a non-interest bearing note class, what we will be able to collect will only be the value stated in the promissory note. And it's just that the amount now will be presumed to be composed of both the principal and the interest. Please take note of the distinction kasi in an interest bearing note, the face value is considered to be principal. The whole face value will represent the principal only. Whereas the face value of your non-interest bearing note will be split between the principal and the implied interest. Because again, we do not believe that we will allow our customers uh, to not pay in cash without us earning any interest on the money that we would have gotten if we asked them to pay in cash. Okay, so the interest in an interest-bearing note class would be an addition, whereas the interest in a non-interest-bearing note is incorporated, presumed to be incorporated in the face amount of the uh, promissory note. Uh, Number 23, if you've read the chapter, how are interest-bearing notes and non-interest-bearing notes, how are they going to be measured respectively? Start with interest-bearing notes. How are they going to be measured?
For interest-bearing notes, sir, they are going to be measured on face value, but while
Okay,
the non-interest-bearing notes, they will be measured at present value.
okay, that's correct. Okay, so if you have an interest-bearing note class, when they are presented in the financial statements, you just follow their uh, face amount. Okay, the value stated in the face of the note. In a non-interest bearing note, it is to be presented in the financial statements at its present value, meaning you have to remove the interest component class. When we are reporting our notes receivable, the amount that we should report in the financial statements should only represent the principal component. Okay, so the amount that will appear in the financial statement should only represent the principal component. Then you would ask, then why do we present the face value when we are dealing with the interest bearing note? Because in an interest bearing note, the face value is already the principal. Okay, the face value does not include any imputed interest, because any interest that we will earn is independent of the value stated in the promissory note. Any interest that we will earn is an addition to the amount indicated in the promissory note. Whereas in a non-interest bearing note class, we will not use the face value because the face value composes of the principal and the imputed interest. Because again, our goal is to present our receivables only, the amount that should be presented for our receivables should be the principal component only. So if we're dealing with a non-interest bearing note, you look at its face value, you remove the interest component, and whatever is left will be our present value. will be the amount that will be reported in your financial statements. When we're talking about present value class, it's just really removing the interest component. Okay, for interest bearing note, the same rule. It's just that there's nothing to remove in an interest bearing note. Okay, so again, just to highlight class, interest bearing note are to be measured at face value, whereas your non interest bearing note are to be measured at present value. Okay, but actually class, both of them are going to be measured at present value. Both of them are going to be measured at present value. It's just that in an interest bearing note class, in an interest bearing note, the face value of the interest bearing note will be the same as its present value. Why will the face value be the same as its present value? Because the face value does not include any interest. Okay? So if we are going to come up with a single measurement rule class, notes receivable are to be measured at present value. But why do we say interest bearing notes are going to be measured at face value? Because the face value represents its present value. Why is its face value the same as its present value? Because there's no interest component in the face value of the interest bearing promissory note. Okay. Plus, we're just dealing with theoretical concepts first class. Okay, but in our examinations, the focus will not be on these theories, but of course, we will not be able to solve the problems without having a good foundation on the theories that are applicable. Okay. Give me a number 1 to 42, Mr. 23.
7, sir.
7. Okay, number 7. Give us the entry that will be prepared for problem 6-1 on January 1, 2021.
Good morning, sir.
Morning.
For the entry, that will be, I will state na the value, the journal entry mismo, sir.
Yeah, sure.
Okay, for the 2021, cash will be 1 million, sir. The notes receivable will be 6 million. Land will be 5 million. Then gain on sale, 2 million, sir. Then accrued interest receivable,
You tell
700.
you tell you tell us debit blank
Okay,
amount.
sorry, sir,
Debit.
sorry. So again, by 2021, debit 1 million cash, then debit 6 million notes receivable, credit 5 million land, then credit gain on sale 2 million. Then
Can you
after, okay,
uh
sir,
what transaction is that about?
the notes receivable mismo, sir, the sale
The sale of,
of the land, sir.
and it was paid in what manner?
What do you mean? What do you mean, sir?
Di ba we sold our land?
Yeah,
How did the buyer pay for it?
a notes by note, sir, promissory note,
And
and it's stated at 7 million.
was
And
the payment done through the issuance of a promissory note lang, or was there some other mode of payment?
yes, sir, the buyer had a down payment of 1 million.
So the transaction here is a sale of our land, which was paid partially in cash and partially in notes receivable. Okay. And how were you able to compute for the gain on the sale? You
I
mentioned of
just
a
deduct,
gain, correct?
yes, sir.
And how were you able to compute for the gain?
I just deduct the 7 million by 5 million, sir.
7 million represents what?
7 million represents the the cost of the land. I mean not the cost, but the kung pila gibaligya ang land, sir.
Selling price.
Yeah, selling price, that one.
And then
That one, and then I deduct the 5 million, the cost of the land, sir. So 7 million minus 5, that would be 2 million, sir. Gain on sale.
okay, thank you, Mr. Savan. So that's how you will normally be computing for gain on sale class. The selling price minus the cost or the carrying amount of the asset in our books. Okay. Uh, the computation is simple class when we are dealing with a sale of land because there is no a junk account or any other related account to your land. Unlike if we are selling a depreciable asset class, you have to be careful. And I'm hoping that you have encountered these kind of transactions before in your basic accounting when you are selling a depreciable asset. When you sell your depreciable asset class, you must recognize all related accounts. So if you're selling a machinery class, you do not just remove the machinery, you do not just credit machinery. You should also remove the related accumulated depreciation account. Okay? And since the normal balance of your accumulated depreciation is a credit, when you sell off the machinery, then your entry should include a debit to your accumulated depreciation. But we do not have that here because your land does not have any contra account. Okay, it does not have any accumulated depreciation account. So the entry would be very simple. Of course, you will be crediting the land. Of course, we will also be debiting cash because we received cash. And aside from cash, we receive a promissory note which evidences our right to collect from the buyer the amount of 6 million. Okay. So from that transaction class, uh, we recognize the notes receivable in the amount of 6 million. Give me number 1 to 42, Mr. 7.
13, sir.
13. Are you here?
Um,
Your number 13 is the one, yes?
yes, sir.
Okay. So what entry will have to be prepared on December 31, 2021 at the end of the first year? Because if you'll recall in your basic accounting class, at the end of the year, as part of your adjusting entries, you will be recording your accruals and your deferrals. Normally, what will be your adjusting entries? To recognize your accumulated depreciation, to record your allowance for doubtful accounts, and to recognize accruals and deferrals. What do we mean by accruals and deferrals? Accruals meaning you will recognize the expenses that were already incurred but not yet recorded, or recognize an income that was already earned uh, but not yet received. So in this case, class, as what I've mentioned earlier, when we deal with notes receivable, it will involve interest, unlike your accounts receivable. And that is what we are expecting on December 31, 2021, 13. Is 13 because
Yes, sir.
uh,
Um,
since we're dealing with a notes receivable here, we expect that
we have
we will have to accrue interest. And what entry will we have to prepare to
accrued,
recognize the accrued interest?
debit accrued interest receivable for 720,000 and credit interest income for 720,000. Then for accrued
Before
um
that, where did you get the 720,000?
interest receivable, we get it from multiplying 6 million times the 12% interest.
Okay. By the way, what kind of promissory note are we dealing with here? Interest bearing or non-interest bearing?
Interest bearing.
Okay, because the problem expressly states that it is subject to an interest of 12%.
Yes, sir.
Okay, and then by the way, when will it be payable? When does the promissory note mature? What's the term indicated in the problem?
January 1, 2023.
So that's for how many years?
Or for 2 years.
Okay, so it's for 2 years. So can you flash the problem again so that we will have a uniform year? So the note class was issued in 2021, and we prepared an entry on December 31, 2021, recognizing the interest that we have already earned, which we have not yet received. Okay. Why do we record the interest class even though we have not yet received it class? Following accrual accounting. Okay. As long as it is already earned, does not matter whether it is already received or not. It should be recognized as income in the period in which it was earned. And since interest is earned through passage of time class, by virtue of the year that has passed, okay, for the entire 2021, for the time that has passed for the entire 2021, we have earned 1 year's worth of interest. So we do not have to wait for the maturity class for the payment date for us to recognize the interest income. Because again, interest is earned through passage of time. If we're going to be very strict, every hour record new interest income. Every second record new interest income. But again, that will not be practical. So we normally do that at the end of the year. Okay. So by December 31, Miss 7, by December 31, 2022, will we already be paid?
No, sir.
No,
Be-
because it matures when?
and January 1, 2023.
So what then should we be doing by December 31, 2022?
We need to um record the next, like the interest that is incurred during that year. So we debit accrued interest of 806,400, and then we credit interest income of 806,400. So to
Didn't
get
we
the
Did we not recognize interest already last year? Why are we doing that again this year?
because it hasn't the interest hasn't matured. I the payment hasn't been the note hasn't been matured yet, sir.
Okay, but we already recognized interest before. Will that not be a duplication?
No, sir. I
Because
will be compounded annually.
because the amount we recorded last year, the amount we recorded in 2021 was for the interest earned for 2021. Why do we have to make another entry in 2022? Because by the passage of time, because another year has passed, class, we have earned another 1 year's worth of interest. So the interest we are recognizing in 2022 class has nothing to do with 2021. The entry that we are preparing in 2022 represents the interest that is earned for 2022 because again, income has to be earned, has to be reported in the period in which it was earned. Class, when we talk about income, class, use the term earned. When we talk of expenses, you say incurred. Okay? For income earned, for expenses incurred. But how much was the amount? The same entry, correct, Miss 13? Debit, what was your entry again?
Debit cash 1 million, sir. Then debit notes receivable 6 million. Then credit land 5 million. Then
No, no,
credit
no, no.
gain bill 2 million.
Did I say 7?
I know, sir. I mean the land would be 5 million credit.
For December 31, 2022, Miss 13. Your entry is still, I'm
Sir,
not
sir,
talking about the, yes.
I am number 7, sir.
Yeah, 13, 13.
Oh.
Sorry. Again,
What's the question again, sir?
what's your entry for December 31, 2022?
December 30. It's still the same, sir.
Which is
Which is debit, um, debit accrued interest receivable, for 720,000 and credit
December
interest.
31, 2022. On December 31, 2021, your entry was debit, accrued interest receivable, and credit, interest income in the amount of 720,000. Will your entry on December 31, 2022 be exactly the same?
No, sir.
So give us now your entry.
Debit interest, accrued interest receivable for 806,400, and then credit interest income for 806,400.
Okay. And where did you get that amount this time?
Six 6,720,000 times 12%.
Where did you get 6,720,000?
6 million plus katong 720K na sa journal entry sa December sa last year.
And why are you including the 720,000 interest earned in the first year?
Kay it is said man na it is compounded annually.
Because interest is to be
And interest
compounded.
is to be
Okay.
compounded annually.
So class, please do not expect, class, that that is the general rule, that if the problem is silent, that is what you are going to do. But we are including the 720,000 in the computation of the 2022 interest class because the problem expressly stated that interest is to be compounded. Okay, let's not complicate the topic first by talking about different kinds of compounding, annually, monthly, quarterly, so on and so forth. But the fact here is, if interest is to be compounded, what does that mean? That interest will subsequently earn interest as well. On the first year, it will only be the principal because we have no existing interest yet. Okay, but on subsequent periods, class, the previously earned interest will also earn their own interest. That's why the basis for your interest income for the second year would be the principal of 6 million plus the interest earned in the first year in the amount of 720,000. Okay, thank you. On January 1, 2023 class, this is the time that we will be recording the collection. Okay, take note, class, just a matter of one day. Okay, of course, we will have to record the interest on 2022 because the interest is earned in that period. We will not wait for January 1, 2023 to record the interest earned in 2022. But by January 1, 2023 class, we will record the payment and obviously we will be receiving cash. And this is, I think, the likely question in a multiple choice problem involving this scenario class. You would be asked, how much would be collected on January 1, 2023? How much will you receive on January 1, 2023? Common wrong answer would be 6 million, the face value of the note. And that is wrong because we will not just be receiving the 6 million, we will be receiving also the interest that was earned for the past 2 years. And how much interest was earned the past 2 years, 720,000 the first year, and 806,400 on the second year, for a total of 1,526,400. So again, if the question in this problem was compute for the cash collection on January 1, 2023, our answer would be 7,526,400. Another common wrong answer, class, to that question would be 7,440,000. 7,440,000. Why will there some students answer 7,440,000? They know that the collection will not just be the face value of 6 million. They know that the collection will include interest. Okay, the collection will include the interest that was earned the past 2 years. But they would forget that the interest here is going to be compounded. So how did they get 7,420,000 class? The 6 million principal plus 720 in year 1 and another 720 for the second year, which is wrong because the interest earned in the second year is not just 720,000 but is actually 806,400. Okay. Plus your takeaway for problem 6-1 class would be that gain on sale will be computed by simply deducting the cost or the carrying amount of the asset sold and deduct it from the selling price. Okay, that's the first takeaway. As was discussed earlier, the gain is computed by starting off with the selling price of 7 million and deducting the cost or the carrying amount in the amount of 5 million. Second takeaway would be the computation of accrued interest, because you will be asked how much accrued interest is earned in year 1. Your answer would be 720,000. How much interest is earned on year 2? Your answer would be 806,400. Third possible takeaway here would be the concept of compounding. In compounding class, interest will also earn interest. So the longer the period of time, the more interest earned, the more interest that can earn interest, resulting in a lot of interest class. Fourth takeaway would be the computation of the amount of payment that you will receive by the maturity of the promissory note, and that is again simply the aggregate amount of the principal of the promissory note plus all the interest that were earned. Let's proceed to problem 6-2. Please scroll it up, Ms. Duanias, and give me a number between 1 and 42.
29, sir.
Okay, 29. Scroll it up, please. So that we can see the requirement. The requirement is just for the journal entries. Okay, who's 29?
Sir.
Okay. So, at a quick glance, Ms. 29, how is problem 6-2 different from problem 6-1? What's the biggest or the primary difference?
The difference, sir, from 6-1 to 6-2 is that 6-2 is a non-interest bearing problem.
Okay. So that's correct. Okay. The problem 6-2 involves a non-interest bearing note. And the transaction here is still a sales transaction. We sold the computer on January 1, 2021. And what would be the entry on this date? 29.
January 1, 2021, sir, no?
Yeah.
Cash, we receive cash, I joke, notes receivable, 600,000,
You say debit.
debit 600,000, credit sales
Give us the
540,000.
account title. Debit, account title amount. Credit, account title amount.
Okay, sir. Debit notes receivable 600,000, credit sales 540,000, credit unearned interest income 60,000.
And where did you get the 60,000?
That is from 600,000 less 540,000, sir.
Okay. So class, understand class that the reason that our entry does not involve a credit to computer class or equipment in the amount of 400,000 because we are engaged in the business of selling computers class. We are not dealing with a sale a of an item of PPE that is used in the operations. We are actually selling inventories here, class. Okay. So another difference between problem 6-2 and problem 6-1 is that what we were selling in problem 6-1 are assets that are used in the operations class. While in problem 6-2, we are actually selling a piece of inventory. Okay, because we are engaged in the business of selling computers. So computers here represent our inventory. And in most problems class, uh, the accounting for the sales transaction is done through the under a periodic system wherein we will not recognize the related cost. Although we have not yet discussed inventories class, I hope you've encountered the difference in the journal entries when we are employing the periodic inventory system and we are employing the perpetual inventory system. Okay. For simplicity, all discussions will assume the use of periodic inventory system when dealing with sales of inventory. If we were using perpetual inventory system class, we would have another entry crediting our merchandise inventory account at the cost of the asset. But here we are not using the perpetual inventory system. So it's correct that the entry is debit, notes receivable, 600,000, credit sales, 540,000, and credit, unearned interest income for 60,000. So moving forward, Tessa, your sales will have to be recorded at the uh, cash price equivalent of the item that is being sold. So even though that we are given a promissory note class with a face value of 600,000, because the true selling price of the item that was sold is 540, the sales will only be recorded at 540. And I hope that makes sense to you now, class. And you will ask, why will the customer give you a promissory note with a value of 600,000 when the computer could simply be bought at a price of 540? Because the customer did not pay in cash. Had the customer paid in cash, then the customer would have paid only 540,000. But because imong giutang, because you only issued a note, you only promised to pay it at a future date, then you will have to pay more. But does that mean the value of the asset that was sold is different now? The answer is no. The difference in the price now actually represents the implied interest class. And this is what I am referring to earlier. That when we are dealing with non-interest bearing note class, there is now an imputed interest. There is already an interest that is presumed to be included in the face value of the promissory note. So that is why we will be recording an unearned interest income in the amount of 60,000. Because out of the 600,000 that we will receive in the future, 60,000 class represents interest that we will earn throughout the term or life of the uh, promissory note. By the way, Ms. 29, what if, again, what's the rule for the measurement for non-interest bearing notes?
Measured at percent value, sir.
So if you will be asked, if you are preparing for a January 1, 2021 financial statement, at what amount will the notes receivable be presented? If you're saying that it's to be reported at present value, at what amount will it be reported then?
600,000, sir.
Why?
Because 600,000 is the present value of
Didn't we say that the 600,000 includes the implied interest or the imputed interest?
so so it should be recorded at 540,000, sir.
It is to be reported at 540,000. It will be reported in the financial statements at 540,000. Okay, but in our entry, in the entry that you have given us earlier, you debited notes receivable in the amount of 600,000. So how will you reconcile the 540,000 reported amount?
Again, sir, I didn't quite get that.
Diba, the question is, if you prepare your financial statements on January 1, 2021, at what amount will the notes receivable be reported? And you said it will be 540 because the 540 represents its present value. But in your journal entry, the first entry that you've given us, your entry included a debit to notes receivable in the amount of 600,000. So if you have an entry that has a debit to notes receivable in the amount of 600,000, how will you explain that your entry is 600,000 but the amount that you will report in your financial statements will only be 540? Because in the first place, everything that will appear in your financial statements will be based on your entries. So if your entry is 600, why will your financial statements be 540?
Because you record unearned interest income, sir, 60,000.
Okay. In your financial statements class, you will be deducting the unearned interest income against the notes receivable. Okay. So your entry was debit notes receivable 600,000, credit sales 540, and credit unearned interest income 60,000. You will post this to the ledger, notes receivable 600, unearned interest income 60. When you prepare your trial balance, notes receivable 600, unearned interest income 60. Okay? But when you are now preparing your balance sheet class, when you're now preparing your statement of financial position, you get the 600 from the trial balance representing the ending balance of your notes receivable, but you would also deduct the balance of your unearned interest income in the amount of 60,000. So your statement of financial position will show an amount of 540 comprising of two accounts really. Your notes receivable of 600 and your unearned interest income. Okay, but I understand if you will get confused, class. What I'm trying to reconcile here is that your entries should lead to the amount that are reported in your financial statements, class. And how do we reconcile our entry wherein we are debiting 600 but we are only reporting 540? Because the amount that will be reported in your financial statements will be net of the unearned interest income. If there's a takeaway from what I have said the past 5 minutes, class, it's that your notes receivable will be presented net of the unearned interest income. If you've gone over the discussion in your textbook, that's actually what your amortized cost tells you. Your notes receivable is to be presented at amortized cost, and one way of arriving at the amortized cost is by deducting the unearned interest income. Okay, but again, it's okay, class, if it's not entirely clear as of this point. Okay, simple takeaway lang. Your notes receivable will be presented net of the unearned interest income. Okay, and please take note, class. Please take note of the primary difference in the entries. On the date of sale, class, on the date of sale for problem 6-1, no entry involving any interest account. For problem 6-2, our entry in the date of sale will already include an account, an interest account. But again, an unearned interest income account. Just understand kasi that accrued interest receivable is different from unearned interest income. Unearned interest income account class is a liability account. Unearned interest income is a liability account. I cannot emphasize that enough. Accrued interest income is a unearned interest income is a liability account. Of course, your accrued interest receivable is an asset account. Last question for Miss 29. What entry will we have to prepare on December 31, 2021? And what's the purpose of that entry?
Debit cash for 200,000. Credit, no. Debit unearned interest income 30,000. Credit notes receivable 200,000 and credit interest income 30,000. The purpose for this sir is we received a
We received the installment payment. That's why we are debiting your cash. And since it's payment, of course, we are going to reduce your notes receivable. I hope that makes sense to you. There's partial payment, so you recognize the cash you received, and you recognize the partial reduction to your notes receivable. But as to the other accounts that you have debited and credited, what's the purpose of that entry, Miss 29?
what was your question, sir?
Di ba your entry was debit cash, debit and earn interest income, credit notes receivable, and credit interest income. The debit to cash and the credit to notes receivable is to record the payment and the corresponding decrease in the receivable. What's the purpose of debiting and earned interest income and crediting interest income?
Sir, because we've already received half of the unearned interest income from January, half of the unearned interest income from January 1, 2021.
That's correct, but technically it's wrong to say that we have received. What we have received is 200,000. As to the interest, we have already earned. Okay, the reason that we will be debiting and earn interest income and crediting interest income is because we have already earned a portion of the unearned interest income which we have recognized in advance on the date of sale. Okay, so the purpose of the debit to unearned interest income and credit to interest income is to recognize the earned portion of the previously unearned interest income. At the start of everything, we were expecting a total interest of 60,000. But of course, this interest can only be earned through passage of time. So we will have to wait for the maturity of the note. After the lapse of 1 year, there's a portion already that is being earned. Let me just discuss the rest of problem 6-2. Thank you, Ms. 29.
Thank you, sir.
Okay. Class, the value of the inventory, stick to 6-2 first. The value of the inventory that we have sold is only 540, and in exchange of it, our customer will be paying us a total of 600,000. Why is our customer going to pay us more? Because our customer will not pay in cash. And what does that tell us? That the premium of 60,000, the extra 60,000 that our customer will ultimately pay us represents interest on the value of the inventory. And this 60,000 class is the total amount of interest that we will earn from this transaction with our customer. And how long will our customer be paying this purchase, this transaction fully? It will take the customer total of 3 years. So what does this tell us? That for a period of 3 years class, we expect to earn a total interest of 60,000. So if our financial statements was not annual class, then If we just prepare a financial statement for the past 3 years, then our interest income would be 60,000. But since our financial statements are to be prepared annually, class, we will have to allocate the 60,000. Okay? Because again, interest is earned through passage of time. Even though full payment will only happen after 3 years, by the lapse of 1 year, class, there will already be a portion that will be earned. So, one possible argument, if the total interest that we will earn, class, is 60,000, if the total interest we will earn is 60,000, it's as if that we are earning 20,000 every year. It's as if we are earning 20,000 every year. Okay, I hope everyone is able to follow where I got that 20,000. Total interest earned in a period of three years is 60,000. 60,000 divided by 3 years is 20,000. Okay, but in this case, class, it's wrong for you to recognize income of 20,000, interest income of 20,000 every year. Why? Because the balance of your promissory note, the balance of your notes receivable is diminishing. Why do I say that the balance of the promissory note is diminishing, class? Because every year there will be an installment payment. Okay? After 1 year, the balance will just be 400,000. After 2 years, the balance will just be 200,000. Okay? So it will not be accurate, class, to report equal amounts of interest for year 1, year 2, and year 3 when the principal, the outstanding balance, or the principal on year 1, year 2, and year 3 are not the same. Okay? So again, there's no question that the total interest that we will earn for the entire 3 years would be 60,000. The issue here is, how do we allocate the 60,000? Will it be correct to simply divide it equally over the 3 years? The answer is no, because the principal, the outstanding balance, out of which interest is earned. Understand, Kasa, that interest is earned based on the principal. So if the principal balance is diminishing, class, then the amount of interest that you should earn should also be diminishing. And if we are to analyze lang, class, between year 1, year 2, and year 3, which one do we expect to earn the most interest? Which one do we expect to earn the least amount of interest? Okay, the answer would be, we expect year 1 to earn the most amount of interest, because as of the year 1, it has the biggest outstanding balance. Why does year 1 have the biggest outstanding balance? Because there was no installment payment yet. Out of the 3 years, which one will have the least amount of interest? It would be the third year, because for the third year, there will be 2 installment payments already. So only the 200,000 will earn interest. Okay. And supposedly, class, we are going to use the effective interest method, but for simplicity, some will use the fractional method, class. Some will amortize the unearned interest using the fractional method. Class, the process of allocating, class, the process of allocating the total interest over the years in which the receivable is outstanding, class, is called amortization. We know that the total interest that will be earned from this transaction is 60,000. Our concern now is, how do we allocate the 60,000? The process of allocation is what we refer to as your amortization. Okay, the amortization of the unearned interest. But again, the standard does not allow you to simply allocate it uniformly throughout the periods involved, class. Supposedly, PFRS 9 requires the use of the effective interest method. Okay, but sometimes some entities, and for simplicity purposes, class, some entities will use the fractional method. Okay, and I hope as you prepared for problem 6-2, you were able to gain understanding on how the fractional method is used. For year 1, class, interest income will be 30,000. For year 2 is 20,000. For year 3, it's 10,000. Okay, and that is based on the fractional method. And that is in accordance with our analysis, class, which tells us that it should be year 1 that will have the most amount of interest, because it has the biggest outstanding balance, while year 3 should have the least amount of interest because at that point it has the lowest or the smallest outstanding balance. Because please develop your own understanding on how the fractional method is being used. Okay. And since we are short for time, we will continue with problem 6-3 next meeting. But again, if you are asked, these are the possible questions for problem 6-2. How much is your interest income? How much is your interest income for? I hope you're taking this down, class. How much is the interest income for year 1? Your answer would be 30,000. And then how much would be your interest income for year 2? It's 20,000. How much is your interest income for how much is your interest income on year 3? It would be 10,000. Then other possible questions. How much is the carrying amount of your notes receivable on December 31, 2021? How much is the carrying amount? How much is the carrying amount of your notes receivable on December 31, 2021? The answer would be 570,000 class. Where did we get the 570,000? Remember, how much was its initial carrying amount on January 1, 2021? It was 540. 600 minus 60. By December 31, 2021 class, it will now be 570. And where do we get the 570? 540 plus the interest earned of 30,000. 540 plus 30. Alternative solution for 570 class. Alternative solution for 570. The 600 face value minus the remaining unearned interest income of 30. Pilay face value sa note class, 600. Pilay remaining unearned interest income, 30. Where did we get the 30? Again, pilay total unearned interest from the very beginning, 60. How much was earned this year? 30. So, if total expected interest is 60 and we have already earned 30, how much is not yet earned? Also 30. And that is the 30 we are deducting from your 600. Again, very important distinction, class. What are the two solutions for your 570? Your 570 is 540 plus 30. But the 30 we are adding here is the interest that was earned. Okay, 540 plus 30. Alternative solution, 600 minus 30. But the 30 we are deducting here is not the same as the 30 that we added in the first solution. The 30 that we are deducting here represents the amount of interest that was not yet earned. Unsa tong 30 nga giada to sa 540 class, it represents the interest that was earned. What is this 30 that we are deducting from the 600? It is the interest that was not yet earned. Why are they the same? It just so happens, class, total interest is 60, portion earned 30, portion unearned is also 30. Okay? Because of this kind of illustrations, class, students would get it wrong in subsequent problems. Okay? Let's go to December 31, 2022. Okay? How much would be the carrying amount of your notes receivable? Pila to siya pa, how much was it at the end of the first year, class? 570. What happened after the first year? We received a payment of 200. There was an installment payment of 200, so there will be a balance of 370. But what else happened? We were to earn additional interest in the amount of 20,000. So if you're asked for the carrying amount of the notes receivable at the end of the second year, class, your answer would be 390,000. Following our alternative solution, how else are we going to arrive at the 390? Again, pila to siya at the end of the first year, 570. Still deduct the 200 payment. You will again have 370. But instead of we will not start. Our alternative solution will start with 600. Okay. So our alternative solution will start with 600. Deduct the payment of 200. We will have 400. Okay? And what are we supposed to deduct? What are we supposed to deduct? The remaining unearned interest. Pila to ang unearned last year, at the end of last year? 30. How much have we earned this year? How much have we earned this year? 20. If remaining unearned last year was 30 and we have earned additional 20 this year, pila na lang ang unearned? How much is still unearned? Only 10,000. And that will be deducted from 400 to arrive at your 390. Okay? So for the end of 2022, the balance of your notes receivable would be 390. Okay? Proceed na lang ta sa third year class. What would be the balance on December 31, 2023? Okay? Starting with the balance of 390 from last year, what are we going to do? Deduct 200. Why are we deducting 200? Because again, we receive another installment payment on January 1 in the amount of 200,000. So balance would be 190. Then add what? How much is the interest income earned in the third year? As I mentioned earlier, it's 10,000. And you will have a remaining notes receivable in the amount of 200,000. Alternative solution for the 200,000. You begin this time with 400 because 600 minus 200 will give you 400. Then what happened the third year? You received a payment of 200,000. Okay? And you will get 200,000. And supposedly we are going to deduct remaining unearned interest. But by the end of the third year class, your remaining unearned interest would be 0. So that's why your notes receivable on December 31, 2023 would be 200,000. By January 1, 2024, it will be paid and everything will be 0. I hope you're able to follow class, but don't worry, I'll share the recorded discussion with you. Hopefully you can review the last parts of this discussion, and we'll proceed with problem 6-3 class. I cannot entertain questions. We have very little time now. Let's just start. I will entertain your questions next meeting and we'll discuss problem 6-3. Okay, thank you for coming, class. See you again. Perhaps next week na din. See you next week, class. You may leave the call.
Thank you,
Thank you,
sir.
sir. God bless.
Thank you, sir.
Bye-bye.
Thank you, sir.